Hello everyone, welcome to Inconvenient Truths. I'm your host, Jennifer Zheng. So far, the second round of the US-China trade war has been going on for more than 4 months. Now, both countries have released a lot of economic data for the first half of the year. Today, we will take a look at how this trade war is going and how long the CCP can hold on. The bottom line, the return of Donald Trump and the second trade war have disrupted the CCP's original plan to return China into a bigger version of North Korea and to enforce long-term social suppression. This could cause China's economy to break in a way the CCP can't control. It might also give ordinary Chinese people who once had little hope of launching any real resistance some unexpected chances to push for change. According to official CCP data, China's GDP grew 5.3% in the first half of this year, and its total GDP is now about 62% of America's. But I'm sure none of my viewers believe the CCP's GDP numbers. So, what's the real situation? Let's look at another set of numbers also released by the CCP, the percentage of industrial enterprises above designated size that are losing money. In China, industrial enterprises above the designated size means companies with annual main business income of at least 20 billion yuan or about 2.8 billion US dollars. This includes mining, manufacturing, electricity, heating, gas, and water production and supply. The CCP's National Bureau of Statistics publishes the total number of such enterprises each month and the number of those losing money. By dividing one by the other, we get the percentage of enterprises that are operating at a loss. This number is relatively reliable because it is calculated from NBA's data, not directly announced by them. So, from this chart, you can see that until 2017, the ratio of loss-making enterprises stayed at around 11.9%. In 2018, as the first US-China trade war began, the ratio shot up. In other words, the 20% tariffs on Chinese exports to the US during the last trade war already hit Chinese industrial companies hard. By 2022, it had doubled to 22.8%. After the second US-China trade war began this April, by May, the ratio had already jumped to 30.4%. If this trend continues, it could reach 40% by the year's end. Some economists say this kind of level is unbearable for the broader economy. China's cash flow could dry up at any moment, and the normal production and business operations can't continue like this. In short, the crisis of a sudden economic collapse is right around the corner and could explode anytime. Another important figure is China's industrial capacity utilization rate. So this chart shows that in 2016, China's industrial capacity utilization hit a historic low of 73.8%. The economy was already in big trouble back then, and the CCP wasn't really ready to switch to a full-on economic suppression model. They couldn't let the economy crash right away. So the CCP rolled out a policy to clear real estate inventory, artificially inflating housing prices to boost the capacity of utilization of industrial companies upstream and downstream. So from 2017 to 2021, utilization stayed around 78%. After the property bubble burst in 2021, it fell again to about 76% by 2022 to 2024. Now, in the second quarter of this year, amid the new tariff war, it is down to 74%, almost back to the 2016 low. These two sets of numbers tell us that as of right now, over a quarter of China's industrial companies have no work to do, and over a third are losing money. This situation is actually even worse than the global Great Depression in the 1930s. With the real economy in such a slump, the only thing keeping China's economy somewhat stable, fixed assets investment, is also shrinking. Here is a heads up. China's fixed assets investment data has been heavily manipulated by the National Bureau of Statistics for a long time. This data is basically worthless in terms of trustworthiness. But even this made-up data is starting to fall apart. According to calculations from the CCP's National Statistics Bureau's raw data, fixed assets investment in the first half of this year was $3.84 trillion compared to $3.43 trillion for the same period last year, an actual growth rate of just 1.3%. But the Bureau officially claims that the growth rate is 2.8%. The 1.3% figure comes from dividing their own 2024 and 2025 numbers. Anyone who knows basic division can figure this out. Yet, the CCP seems to think Chinese people can't do math, so they claim it is 2.8%. If you look at the monthly numbers, January to February showed a 3.5% growth rate, thanks to the stimulus from issuing $1 trillion in special government bonds. But after that boost faded, the growth rate dropped to 2.8% in March, 1.1% in April, 0.7% in May, and by June it was negative at minus 0.12%. This shows that with the real economy in a deep slump, local statistic offices can't keep faking the numbers. They are forced to report somewhat real investment data. Even when the National Bureau of Statistics compiles this data and tries to inflate it, there is a limit of how much they can fake. The result, a grim picture of shrinking investment. There are two other data sets that can serve as a reality check for fixed assets investment. So the first comes from China's Ministry of Transport, showing fixed assets investment in highways and waterways. From January to May this year, it shrunk by 70.7%. That's a significant drop. The Ministry of Transport is a functional department, not a stats office that's always faking numbers. They don't have to take responsibility for economic prosperity, so they just compile the data reported from local levels. There's no incentive for them to fake it, making this data relatively reliable. The second data set is China's cement production. Cement production in China can already be used as a substitute indicator for fixed assets investment. This is because the fixed assets investment data as a core economic indicator has been heavily falsified. Cement production, on the other hand, is just an ordinary industrial output, a statistic that almost no one pays attention to. However, almost all fixed assets construction needs cement. And cement is basically not imported, and it is not easy to store for long. Therefore, cement output can represent the most realistic changes in fixed assets investment. So in the first half of this year, cement output fell 4.1% year-on-year. This decline is already relatively mild because of the stimulus from 2.3 trillion yuan worth of special government bond. Otherwise, based on the previous trend, the drop in the first half of this year could have reached 15%. In the financial sector, along with the sharp contraction of the real economy, the entire financial system has now completely turned toward government debt. Here, I have provided the social financing increment data from the first half of 2019 to the first half of this year. Please pay attention to the increment in government bonds. In the first half of 2019, the increment of government bonds was 344 billion US dollars, making up 16.8% of the total social financing increment. In the first half of 2024, the increment of government bonds was 467 billion US dollars, with a share of 18.4%. This could still be described as a small increase without an out-of-control jump. The reason was that last year, the CCP's Ministry of Finance still had strict controls on the issuance of government bonds by local governments. At the same time, the entire financial system had rather strict restrictions on buying government bonds. So at that time, the growth in the share of government bonds are not too large. However, in the second half of 2024, the issuance of Chinese government bonds sped up, and the entire financial system could not absorb them. So the central bank was forced to step in directly and buy 1.35 trillion yuan worth of government bonds. So by the end of 2024, the central bank and the National Financial Regulatory Administration completely removed all restrictions on various financial institutions buying government bonds. The Ministry of Finance also completely changed its stance and encouraged local governments to issue large amounts of government bonds. This led to an unprecedented surge in the increment of government bonds in 2025. In terms of the numbers, in the first half of 2024, the increment in government bonds reached $1 trillion compared to 467 billion in the same period last year. This is an astonishing 129% increase. The share of government bonds in total new financing shot up to 33.5%. This also means that 1/3 of all the growth in financing in the entire financial system is supported by government debt. Please note, the figures in this table are increment data. They are not the absolute totals of bonds issued, so they do not include the part where new debt is issued to repay old debt. In fact, in the first half of this year, the total issuance of Chinese government bonds was $1.89 trillion. If you subtract the $1 trillion in financing increments, the part used to repay old debt was $890 billion. 8 months ago, a Chinese economist did a program analyzing the scale of local government bond issuance over the years and their maturity dates to estimate the death deadline for China's financial system. The conclusion was, if most of the new government bonds are purchased by the central bank, the entire financial system can at most last until the first quarter of 2027. But now, with the CCP's reckless approach, removing all disciplinary limits, encouraging local governments to issue bonds widely, and allowing all kinds of financial institutions to use any funds they can to buy any government bonds they want, this will greatly speed up the arrival of that deadline. Some economists predict that at most it can hold on until the first quarter of 2026, when the entire Chinese financial system will completely lose liquidity, and even banks will face a brutal situation of cash flow breaking. In fact, in 2013, China already had a money shortage crisis. It was only because at that time the real economy had not yet collapsed that it could be saved. But when the second money shortage crisis hits because of this wave of reckless actions, it will be impossible to save. At such a dangerous moment, the CCP's way of responding is, of course, very CCP style. In the first half of this year, the CCP did almost nothing for the economy except for one thing, completely canceling the policies to control real estate, changing the policy direction to encourage people to buy houses, and trying to get one last harvest from the people. Other than that, all of the CCP's energy has been focused on strengthening control over society, and almost on finding all kinds of ways to seize money from the public. Recently, there have been multiple incidents of well-known private business owners being forced to jump to their deaths. A few days ago, I even got an exclusive tip in Zigong City, Sichuan Province, a very small city. The police froze 14 million yuan worth of bank deposits belonging to 79 Chinese citizens for no reason. Most of these 79 citizens do not live in Zigong City, and their bank cards were not opened there. You could say they have no connection to Zigong at all. But the Zigong police actually asked the head office of the Industrial and Commercial Bank of China to freeze the bank cards of these 79 people. They did not notify the people involved when freezing these accounts. The bank also did not notify them. The victims only found out when they tried to withdraw money and couldn't. When they asked the Zigong police, the police simply said that based on past investigation experience, they believed these bank cards might be linked to telecom fraud or gambling, so they froze them. However, the police had no evidence to prove that the source of these people's funds was illegal. They didn't even open a case for investigation. They just demanded that the victims prove their innocence by explaining where every single sum of money came from before the accounts could be unfrozen. So these are the notice of assistance in freezing property issued by Zigong. By law, they can only freeze accounts for a maximum of 6 months. So when 6 months passed, they simply issued another notice to freeze them for another 6 months. These notices were sent to the Industrial and Commercial Bank of China. The victims only got it from the bank when they went to ask questions. The police never notified them directly. In my view, this is open robbery. Previously, there was a term on the Chinese internet called deep sea fishing. It referred to police crossing provinces or regions to find ways to rob private business owners of their money. Now, this deep sea fishing has expanded to ordinary citizens. Among these 79 people whose funds were frozen, some are elderly, who live only on their pensions. They have nowhere to seek justice, so they contacted me, hoping I could help expose this. So from China's macroeconomic data to this individual case of 79 people having their money seized by Zigong police, we can see that China's economy is quickly heading toward total collapse. All right, today's program is already long enough, so I will stop here. Please help by liking, sharing, and leaving a comment, or by visit my website at jenniferzengblog.com to sign up for a membership or donate to me. Finding and expressing the truth is not easy. Thank you all for your support. Thank you and see you.